The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon and welcome to our webinar today, February 28th. And the topic for today's webinar is captive insurance in today's business environment. Apologize for the delay in getting started, a little technical problem, but I think we're ready to go now, and it'll be an interesting 60 minutes and give us a chance to learn a little bit about captive insurance. Again, we will be offering CPE credit for the program, and as such, we'll be giving 3 CPE codes throughout the program. And if you want to receive CPE credit, you will need to take note of these codes and return the completed CPE form to Lynn Keenley in our office. So with that, I'll begin the introductions. The presenters today are Stuart Stagner with Innovative Risk Management. Stuart has 30 years of experience in the insurance industry. He's received the Accredited Advisor in Insurance Professional Designation from the Insurance Institute of America, and he has been active in various professional organizations throughout his career. In 1991, he formed IRM and to specialize in the alternative risk transfer market. Since that time, IRM has grown to provide a wide array of services, including risk management, consulting, program administration, claims administration services, and safety consulting. In 2003, IRM was named as the program manager for AssureX Global Partners Capital Initiative. AssureX members are among the largest independent brokers in the United States. IRM's clients include specialty programs, single-parent captives, group captives, agency captives, association captives, self-insured entities, and self-insured groups. Stuart has been a speaker at various industry conferences on captive insurance, and he has authored a number of articles for National Insurance and Risk Management publication. He holds a Bachelor's of Business Administration degree from the University of Texas. Also with us is Jeff Leitner with Brower Insurance. Jeff has more than 16 years of experience in the insurance industry. Dedicated to the practice of providing risk management solutions to his clients, Jeff spends a majority of his time working with clients in the construction, real estate, and manufacturing industries. The scope of his experience has spanned virtually all aspects of the commercial and personal insurance marketplace. Jeff received his bachelor's degree in marketing from Wright State University. Also with us with IRM is Brian Ricci, and Brian is the Director of Marketing for IRM, and Brian is also based out of the Irving, Texas office and has a bachelor's degree from Angelo State University. So I believe, Jeff, you're going to get started, so welcome, guys, and Jeff, go ahead and take it away.
Great. Thanks, Jack. Welcome, everyone. We appreciate you taking the opportunity to learn about captives today. What I wanted to start out by doing is putting in perspective where captives fit in a traditional insurance program. I'm going to assume most of you understand a traditional insurance program being property insurance, general liability insurance, automobile, work comp, possibly professional insurance as well. One of the things that Brower does for its clients is assesses those risks and helps determine whether or not those risks need to be transferred to an insurance company in the form of buying insurance or retaining that risk. There's several ways to retain that risk, maybe implementing a large deductible, joining a risk retention group, or possibly creating or joining a captive. Within the captive world, what we see most often is either a single parent captive or a group captive. The types of risks that typically go into captives are the general liability, the workers' comp, automobile, and professional liability, sometimes property. But it's those clients that are spending in excess of $300,000 in premiums on any one line or any group of lines together. When we get to the point where we want to analyze a captive, that's when we will utilize Stuart's firm, Innovative Risk Management. So hopefully that puts in perspective where a captive comes into play compared to a traditional insurance program.
Okay, before Stuart gets started, I'm going to give the first CPE code, and that code is the number 17.
Good afternoon. Thank you guys for joining us. We would certainly encourage you through the WebEx to ask any questions that you have. We certainly want to be responsive to specific questions, so we encourage you to use that as we go through the presentation. Just a brief commercial on innovative risk management. I formed the company in 1991. We have 40-odd employees, primarily based in Dallas, although we have offices in Phoenix and Tucson as well. We administer about $100 million of primarily specialty and captive business. And we also have a captive insurance company of our own, so we're an active risk assumer and have been since the inception of the company. Just to talk briefly here, kind of define what captives are, is they're really, at their essence, nothing more than a self-insurance mechanism. And it's typically an entity or a group of entities that go together to form this captive entity. And one of the common characteristics is most of the time they're not in the insurance business. They may be a group of hospitals, or it may be a group of manufacturers or contractors. And their primary business obviously is in, say, construction or hospital management, but they formed a captive really to self-insure the risk of the member or members. If you go back and look at the history of captives, they've been around some period of time. Gulf Oil Corporation, for instance, had a captive insurance company that they formed in the 50s, primarily to provide themselves product liability insurance because it was unavailable in the standard market. In the 70s, we had a medical malpractice or hospital professional liability crisis where that coverage became largely unavailable and unaffordable. And so you found a number of hospitals who went offshore, formed captives themselves to self-insure their hospital professional liability insurance. And today, even though it's opaque to you, most of the major Harvard Medical School, Sisters of Mercy, number of major hospital systems still have their hospital professional liability insurance provided to them by their own captives or group captives. Kind of what happened really in that process really was that, clients who really, what drove these people to form in these insurance companies really was not because they woke up one day and decided they wanted to do a captive insurance company. Obviously, it was because it was a need-based. It was something where the market, either the lack of availability or affordability of insurance, drove them into this arena, and they did so really with some significant concerns about how it would affect them from a volatility of loss standpoint, cash flow, all of those things. And really what happened, though, was a very positive experience because they learned that, if for a large enough client who is if they're going to finance or they're going to pay their own losses over time, rarely are you going to beat the insurance company year in and year out. And so what ended up happening really was most of those clients had very positive experiences, and they eliminated the sort of unequal trading of losses that goes on in a traditionally insured environment. And so the cost volatility that they anticipated didn't really materialize, provided the coverage was being funded correctly. So the success of that concept, which at that time were largely individual, what we call single parent captives, meaning that the only person insured in the program was the sponsor of the captive, but the success of that concept really spawned the growth of what we today call group captives in the 80s really began, where smaller companies would bind themselves together in groups of similar risk characteristics, and they would form these captives to self-insure the group, all of the members of the group. Today, as you can see on the screen there, the captive and alternative risk business is about 30% of the overall commercial lines marketplace, which is about $100 billion of insurance, so it's certainly a significant component of the market today. If you break that down really into the size of companies that typically have participated in the alternative market through captives, this slide breaks that down from companies that are small, medium, and large, which are defined as less than $100 million, between $100 million and $1 billion, and then are larger than $1 billion in revenue. And you can see that in the clients above $100 million in revenue, it's a significant component of their total overall insurance spend is being done in alternative risk mechanisms. The fastest growing area that we're seeing today is in accounts that have 50 to 100 million in revenue. Just going to talk through a couple of details about what you'll typically see in the market in terms of captives. As I mentioned earlier, the single parent captives are captives that are set up largely to, for instance, the Gulf Oil Corporation. It's only going to insure the risks of Gulf Oil. So that's what we call a single parent. That's generally the Fortune 1000 type companies, and so to some extent beyond that. But certainly if you look at the Fortune 500, probably 350 or 60 of those have captives set up to manage their risk. Then there's also association or group captives, and those are, as I mentioned, sort of smaller companies who have gone together to self-insure the risks of the members. And we typically define groups as clients that are larger than 300,000 each account will typically go into a group captive, and then association captives are normally sponsored by the association, and those are generally, not absolutely true, but generally accounts that will be less than 300,000, many times even as small as $50,000 or $60,000. There's also agency captives. Many agencies, insurance agencies, will form insurance captives to self-insure the risk, or to take a risk position, I should say, in the business that they actually sell to third parties. One of the things that you'll see battered about really and discussed is kind of the various tax designations of insurance companies. And I set this slide up. I don't want to get too down in the weeds on this issue, but just to set it up to talk about one that I expect that you have either heard about or will hear about. But to start at the top there, most of these captives, and we'll have another slide that speaks to this in a moment, but are formed offshore, and they're owned by U.S. shareholders, and so they're called what are called controlled foreign corporations, or CFCs, and that's nothing more than a foreign domicile captive that is, or any company actually that's controlled by all U.S. shareholders. Unique to insurance is there's something called related party insurance income, or RIPI income, which I have there parenthetically, which has to do with how you can certainly structure a captive in such a way to avoid being a CFC, but then because you're only insuring related party risks in the captive, that brings it back into the definition of a CFC. And so most U.S. Most captives that are domiciled offshore that are insuring U.S. risks are CFCs in some manner or another. And there's a couple of ways that those companies get taxed. One of the ways is that the IRS code gives you an option to make what's called the 953D election, which is nothing more than a foreign company that is a controlled foreign company that is elected to be taxed like a U.S. corporation, and then it files a U.S. return just like any other corporation. The other way that the CFCs will get taxed is basically it's like a partnership where each shareholder will get a 5471 form that says this is your proportionate share of the profit. So there are very few ways post-1986 that to sort of avoid taxes in these captives. Certainly there's been some recent legislation on that matter that we won't get into today that's affected that even further. One of the things that you'll see in some smaller, for instance, automobile dealerships and other things have taken advantage of both of these next two categories, and these are both apply to captives. And the one is the 501c15, which is an insurance company with less than $600,000 in revenue. That's both of these statutes were set up to affect a positive environment for the old farm mutuals that would start up. And so these regs have survived this long, but they today, most of the time they're being used for captives as opposed to sort of startup insurance companies. But any insurance company with less than $600,000 in revenue is completely tax exempt, and so you'll see that designation used sometimes. And then there's an 831B company, which is something that several of you may have heard of out there. That is a company that writes less than $1.2 million in premium, and that is an exemption where they don't pay any income taxes on their underwriting income, only on their investment income. And I mentioned that mainly to just familiarize some of you with that class. This sort of is a typical structure of these 831B companies. Is most of the time they will insure what I would consider to be non-traditional risk. It might be weather problem related to an outdoor event. It may be many times what you'll find if you take the exclusions that are commonly found in a liability policy, and they will insure those. And it might be currency risk. It might be other things that are difficult to value, certainly, and not sort of terribly suspect to a loss. So, and the way that they've normally done is that a group of individuals will put premium in. They take 51% of that premium and put it into a pool of all of the clients that are members of this deal, and then 49% of the risks are then retained outside of the captive, and then the captive will then reinsure a proportionate share of the entire pool above. And effectively what that's trying to do is work around some of the safe harbor rules that have come out of certain IRS rulings to achieve that. One of the things you see these used for today is many wealthy individuals are using them to shelter income taxes. And so it's what I would say is the structure is out there. It's perfectly legal, but be careful, because there are, as in anything like this, there are people who are doing it well and people who are not doing it as well, and structure is going to dictate the success of your ability to avoid tax. And so I would recommend, if somebody is talking to you about an 831B captive, that you take great care and get independent tax advice on this, because it is something that certainly is. There are a number of hucksters today in the arena that I would go quite cautiously. Having said that, there are certainly people who do it well, but my advice to you would just be careful in this arena. You know, one of the questions we always get is, why are so many captives offshore? And certainly you're starting to see U.S. domiciles compete and grow, but certainly most captives are still domiciled offshore. And the main reason is because they were first to see the opportunity. And before 1986, there were some significant tax advantages to being offshore. You could insure your risk to a captive that you owned offshore, and effectively all the underwriting income was tax-free pre-1986, and that certainly changed and since then. But that was one of the early reasons for people forming captives. There were also lower capitalization requirements. Most of them had Cayman and Bermuda, the two leading domiciles, and they had specific captive enabling legislation. And then they developed the best infrastructure. I mean, if you go to Bermuda, every major bank in the world is there. All of the big, I guess, remaining three accounting firms are there. If you look at the captive infrastructure of administrators and insurance companies and that type of thing, are certainly all in those domiciles. Organizationally, typically these captives are set up as either what we call equity or pure captives, meaning they are owned by the members themselves, and they make the equity investment. They form they create the capital around these structures. The other type of structure that you'll see out there that's being used a lot is what's called a rent-a-captive facility. My analogy on that is somewhat akin to when you decide that you want to live in a particular place. You can either go out and hire a contractor and build your house from the ground up, or you can go in and buy a condominium. And to a certain extent, the rent-a-captives resemble a condominium type approach, where somebody else has built the building, somebody else has decided on your floor plan, and then what happens is you go in and you still get a place to live in either one of those examples, but it gives you an opportunity to get into a place to live with much less lead time, much lower cost, and typically lower ongoing cost, and that's part of why these rent-a-captive facilities have grown so much.
Stuart, could I interrupt with a question at this point? And maybe this is a question that you and Jeff work together. How, when you're looking at a potential client that you think a captive might be applicable for, what do you see, and how does it bubble up to get to your attention, and Jeff, maybe even from the agency level? What is it that piques your interest and say this is something we ought to pursue?
Well, the first thing we want to look at is loss data. You know, if they're a company that's not having a lot of losses and they're just transferring their premium dollars to the insurance company, and the insurance company is investing those and making profit, you know, that will be one indicator. And if they fit into the 300,000 plus in premium range, that's a trigger for us to reach out to Stuart's firm and say, hey, this might make sense. Let's dive a little more. Let's dive deeper into the analysis of the overall program and the losses.
Yeah, I certainly agree with that. The losses are indicative. We always have a slide about who fits in a captive, and typically it's the people who are ready to wrest control of the insurance transaction away from the insurance company. You know, people who are producing an underwriting profit for the insurance company over time. But if you think about it, insurance is sort of the socialization of losses, meaning the good people subsidize the bad, and part of the ideas around these captives is you want to eliminate that subsidy. You want to create, either through good underwriting and a risk-sharing program that is sort of everybody has a selfish motivation to do well, that you eliminate the inherent subsidy of the poor performer who's not paying attention to loss control, who isn't paying attention to safety and risk management, claims control, all of those things. So. And not certainly every opportunity we see fits. Some of them won't, but that's first part of what you look at is how are they doing? Have they consistently produced an underwriting profit for the insurance company?
Is there a thin line between self-insurance and captive?
Yeah, I mean, captives are one form of self-insurance. Many states have enabling legislation for self-insured groups for workers' compensation. Obviously, the federal act has a risk retention group. All of those are really forms of self-insurance. Single-parent captive is a form of self-insurance. The sort of interesting thing about that people should be aware of in terms of the distinction between self-insurance and a captive is that typically in a captive, there will be what's called an issuing carrier. And that might be the Hartford or the CNA or the Travelers or Arch or one of the companies that you would have a recognizable name. They're typically a public company. They carry a Standard & Poor's rating. They have an AM Best rating. And the sort of the benefit for the client in a fronted group captive like that is that if you are, and contrast that with a self-insured client, is that if you are in a fronted captive like that where there is an issuing company in front of the paper, that issuing company bears all of the sort of credit risk of default of the reinsurer, so that in the event that the reinsurer 7 years from now, when you need them to pay your medical professional liability claim or your workers' compensation claim, in the event that reinsurer has gone bankrupt, that the risk now of that runs to the Hartford or to the CNA, as opposed to a self-insured group, where typically most states require you to have sort of a unlimited joint and several liability. Mm-hmm. And so if you're in a self-insured group and that reinsurer goes bankrupt and can't pay, that doesn't diminish the obligation of the self-insured. So that's one of the important distinctions between a captive and a self-insured, is it allows the client to minimize and limit their liabilities.
When you have a captive and you enter into a contractual relationship where you're assuming some liability, let's take the construction market, and you need to have a certain level of insurance. So the contract will specify it has to be a best rated such and such. Does that captive inherit the rating of the fronting company?
Yeah, well, in essence, what happens there is the issuing company is the one upon who, like for instance, Brower would issue a certificate of insurance, and it would say the Hartford or the Arch or the CNA. And obviously, because that issuing company is taking on that risk, they're charging a certain premium or a certain percentage of fee, typically, that to the captive. But the captive then becomes a credit risk of the Hartford. So from an upstream, downstream contractor, if you're a prime contractor, or if you're a sub, you have you don't have to worry, and you don't have to worry about disclosing to your clients that they have a captive, because ultimately the issuing company, Hartford or CNA in this case, is responsible for paying all those losses. So the subcontractor could give the general a certificate of insurance, and it would say the Arch Insurance Company, and so whether the captive could or couldn't pay isn't a risk to the general in that case. So, okay, good question. Kind of the advantages, these are really typically the advantages that are cited for people moving into captive. Mainly control. It's control of the claims process, it's control of the underwriting process, it's control of the safety and risk management process. All of the things that impinge on success are really the things that the client are looking to achieve, because in a captive transaction, typically all of those service providers work for the captive as opposed to working for the issuing company. And that's a distinction between, let's say, a large deductible program where all of the adjusters and all of the underwriters all work for Liberty Mutual, let's say. In a captive, typically the service providers work for the client, and obviously that ramps up the service level, because you have the ability to fire that service provider if they don't do a good job, and they become somewhat of an interchangeable part in the transaction, as opposed to the fact that if you're with Liberty and you love them but you can't stand their claim service, you're just sort of stuck with it. So the well-designed captive has a lot of interchangeable parts that make all of the service providers more responsive to the client. Obviously, the other thing is investment income, maybe not as much in today's investment environment, but certainly that's one of the things insurance companies don't like to talk about. Is a significant component of their profit is the fact that you pay your premium on day one, and the average work comp claim will get paid out over 7 to 10 years, and their money makes money over time, and so that's a significant component of profit that's being given over to the insurance company that's not necessarily clear when you pay your premium. The direct access to the reinsurance markets, obviously reinsurance companies operate at much lower expense ratios, so there's fewer dollars that are being diminished through G&A. Obviously, you get to retain the underwriting profit. That's the primary motivation. There are certain economies of scale that groups get, because they are able to, any one client can't buy as efficiently as a group of clients bundled together. And then the target is obviously stabilization of the pricing model and the market availability. This is just an example of the investment income that I mentioned a moment ago. These are the payout profiles of these various types of claims, with the blue being property, work comp is in red, and the general liability is in green. And this is a slide that I did back when interest rates were about 5%. But if you look at the payout profile, really on workers' compensation, if you're able to earn 5% investment income, it only takes about 83 cents to pay $1 worth of claims, because those claims are paid out over a long period of time. So you certainly see that investment income is not an insignificant part of the profit transaction for insurance companies. Kind of who fits, we talked about this a moment ago. It's people who are dedicated to controlling losses, people who are really tired of being controlled by insurance companies, typically accounts that are more than $350,000 in standard premium, somebody who sort of wants to be self-insured but isn't quite large enough. Typically, we don't recommend clients enter into single-parent captives unless they're $3 million or over in premium of their own. And then typically the financial wherewithal, your balance sheet strength is certainly something that you're looking at as a qualifier for captives. You don't want the thinly capitalized or marginally profitable firm, because they really don't have the ability to sustain and finance their risk over Sort of why insurance matters. You see people talk about single parent captives sometimes who want who really aren't in a position to transfer risk inside their own economic family. You'll find that sometimes they'll set up captives that'll be really just self-insurance vehicles and not insurance vehicles. And what I mean by that is, in order to achieve deductibility of the premium, the transaction must pass the test of insurance, and there's several IRS rules around that. But the reason that you're trying to make that happen is the fact that it creates favorable tax treatment for the insurance company, meaning the captive, because they get a deduction for their discounted loss reserves and so forth. But it also creates premium deductibility on the part of the client. So there are several. That could be its own webinar, and maybe will be at some point. But suffice it to say that any captive transaction that you or your clients get into, you need to make sure that that transaction qualifies as insurance.
Before we go to the next slide, I want to interject the next code. That CPE code number 2 will be 27.
Thanks, Jack. Kind of why is the market moving to captives? This is the fastest growing area of commercial lines insurance today, and really it's because of that socialization aspect that we talked about. The best clients are tired of subsidizing the worst clients. And if you think about the concept of large accounts, generally these group captive accounts will average $600,000 to $800,000 in premium. Those size of accounts are going to pay their own losses over time. Now, you're just not going to beat the insurance company year in and year out, and because of that, the most efficient way to pay those losses is to finance them yourself and not pay the insurance company a markup so that you can give them $1 and they can give you back 60 cents to pay losses with. And certainly as the market does begin to change, appears to be changing, the clients are, as the movie said, it's a box of chocolates. You never know what your next renewal will be like, because too many times your renewal is much more dependent on what the external market looks like and not so much your own performance. And most clients who enter captives, they want to be dependent on their own performance. We're going to go through a series of slides that just sort of goes through the technical aspects of how this works. And the first slide is really just going to talk a little bit about what the traditional guarantee cost buyer looks at, and that is, you have a company, they obviously pay a premium into the insurance company, and in return for that, the insurance company assumes the risk. That risk gets transferred from the insured over to the insurance company for all of the things that are covered under that contract of insurance. And when you pay that premium dollar in, there's really 3 components of the insurance company is looking at. The first is really a loss fund, meaning their prediction about how many losses are going to come tumbling out, or their cost of goods sold, if you will. Then obviously their profit and investment income, which is the profit load on the margin that they expect to make plus the investment income that they expect to make. And then it's really the G&A costs, and those are all the frictional costs of doing the transaction. That would be cost of claims administration, the cost of loss control, safety, underwriting, state premium taxes, all of those kinds of things are really considered to be frictional costs. And one of the things that we do in captives is really combine the first 2 buckets, because you've got the same party and interest, and we create really just 2 buckets, and those are sort of, one is for the loss funds and one is for the fixed cost. And the most sort of important thing to remember about a captive is that everything in the loss fund bucket that the client doesn't spend in the way of losses, they get to keep, and they keep that generally through a dividend scheme that's overlaid in the shareholder agreement of the captive. So one of the things that kind of the first half of a captive transaction looks like, the exact same transaction that the client's in today. And the difference is that in a captive, part of the risk and part of the premium gets transferred over to this new captive, and many times that'll be a significant component of the spend, depending on the size of the client and the size of the captive. It's not unusual for that to be 60 to 65 cents out of every premium dollar that'll be going over to the captive to assume the risk, because most of your insurance premium that goes in is to pay the sort of what we would consider to be the lower level losses that'll be $300,000 each and less. So if we took those two buckets on this next slide, and I've just stacked them one on top of the other, and so you have the expenses, which are the costs, and then you have the loss funds, which is the amount left over to pay losses. But none of your clients want to get into a pure self-insurance scheme. They want to get into something where they're still managing their risk. And so typically the clients don't want to have any kind of unlimited liability. So what we do is purchase reinsurance. And what that does is really decreases the amount of loss funds that are left available to pay losses, but it also limits the number of losses and the kinds of losses and the amount of losses that are that the client is responsible for. So it's somewhat of a hedge position that the client is basically taking the catastrophic type risk and reinsuring that component with a third-party reinsurer. Sometimes that third-party reinsurer is not a third party. They're affiliated with the issuing carrier. In my example, the Hartford or the CNA, they could be an affiliate of that group, or they might be a true third-party reinsurer. This next slide sort of shows the typical structural outline. On the horizontal axis, those are cumulative losses. That's not showing up quite as well on the screen, but the vertical loss is each individual loss. And the way that you limit the liability through the purchase of insurance, or reinsurance, I should say, for the client is we limit it in really two ways. The first is on what's called a specific basis, meaning that any one loss is limited, and that can be, in this example, it's limited to $350,000. It could be higher or lower depending on the client's size and risk appetite. But that specific excess coverage, which is in the red section above, will typically be either retained by the issuing company or reinsured to a third party. And so what that does is it limits your clients so that if they have 3 people killed in an automobile accident, they're not out millions of dollars, that they're still limited to that loss of whatever amount that's been selected. In this example, $350,000. The other exposure that you as clients have for a loss is an accumulation or an aggregation of loss, meaning that you don't have any losses less than $350,000, but you have a lot of losses less than $350,000. And so what the client wants typically is to have some aggregate, or sometimes called stop loss insurance, so that if things go poorly, they know in any one policy year that the most I can lose is X. And one of the things that most issuing companies will do then is they'll create effectively a gap. And that gap is defined between the gap between the captive loss funds, which is the area in the blue, which is essentially the amount of premium remaining after all the expenses have been paid that the client has just out of the premium to pay losses, and the gap between that amount and the attachment of the aggregate stop loss insurance. So what this is the sort of win or lose component of the client's transaction, meaning that if they hold their losses down and do a good job, they can keep everything in the blue that's left over that they don't spend to pay losses. But if things go poorly, they could have to pay an additional amount up to and including the full amount of the gap. So it becomes somewhat of a swing-rated type program where the client may have, let's say if they're paying in $1 of premium, they may be able to get 65 cents of it back plus investment income if they do well, but they might have to pay another 40 cents, let's say, if they do poorly. So it might be a swing rate. If I'm paying in $1 and my cost might ultimately be 35 cents, and it might be $1.40 depending on, and those are round numbers, but typically that's the way it'll work. And so most well-performing clients, if you overlay that model over their last 5-year history, you'll see that they've given over a fair amount of underwriting profit to the insurance company. And then that's part of the motivation is, how do I keep that underwriting profit that I'm giving over to the insurance company? when you're looking at a client, this parabolic curve is sort of defines sort of how we decide where the client should take risk, and typically what we'll do in that environment is we'll look at it based on, in this case, the vertical axis is the severity of loss, and the horizontal is the frequency of the claim occurrence. If you look at sort of the claims that don't happen very often, but when they do happen, they're a big dollar amount, those are the claims that you typically shouldn't self-insure. You should try to reinsure or transfer the risk to someone else. On the other hand, if you have what we call improbable losses, meaning losses that may happen to you periodically, but not every year, maybe once every 5 or 6 years, that typically is a loss that is retained both by the client as well as the group of clients. So they're buying insurance from one another. And then the other is the sort of predictable losses. Those are the sort of nits and gnats, the slips and falls, small dollar losses that don't cost very much, but they tend to happen more often.
Stuart, if I could ask you a question at this point. As we look at that curve, if I'm comparing it to self-insured health claims, that's going to be fairly predictable based upon our demographics. This curve can get really skewed based upon loss of culture or change of culture within an organization. How do you keep your grips on your safety culture? Because you can have a company for the last 10 years under a management team where safety has been right at the top of a list. Certain things change, maybe just retirements within an organization, and all of a sudden that safety culture is lost, and that curve can go upside down.
Absolutely, and it is something that is sort of the biggest management component of this, is keeping your safety culture, and that's part of why the service providers have to be engaged at the level that they are, is because you can't have that change, frankly. If you see it coming, then you should get back into the standard market, because it's something that our client captive members have. I mean, it's a lot of focus on it, and an example of there's also a fair amount of peer pressure. These groups know, they're all successful businesses, very financially successful, and when the CEOs come to their quarterly meetings, they don't want to be the last in terms of losses, and so there creates a competitive pressure inside the organization to build on that safety culture. But it is something that if that changes. I'll give you an example. We had a client that was acquired by a venture capital company that acquired 60% ownership, and the entity went on an acquisition spree, changed that culture, and things went poorly. And frankly, the rest of the members of a particular captive that we have asked them to leave because of that. So it is something that's a critical component of kind of what kind of safety culture and what kind of attention to detail that you have in terms of captives. So back to this slide, one of the things that I mentioned about these two boxes in the yellow is most of the profit and most of the premium that the client pays in are in these losses that would be retained in this scheme. So just kind of taking that one step further, going back to this slide, which we talked about, the first half remains the same. And so what we're doing really is trying to leave the catastrophic risk with the insurance company and then having the captive assume the predictable and improbable layer. So that's kind of the model that we tend to follow when we're looking at a particular client or even a particular group captive. This is, as we call it, our lawyer slide. The thing you have to understand about a captive is it is a business venture, and you can lose the money that you invest in it. And although it's unlikely that all of your money could be lost, it's certainly within the realm of possibility, even though probably not in the realm of probability. And certainly you could lose your premium, your letter of credit, any accrued profit, the share purchase price if the captive were dissolved. Certainly in our experience, we've never had that happen, but it certainly is possible. And the clients, when they go into these, they need to understand if there's a possibility that they could lose money. We gave this slide to a client not long ago, or a prospect not long ago, and he said, well, one thing's for sure, if I give over $1 million to Liberty Mutual this year, I'm guaranteed to lose that. so that's an important comparison, sometimes out of the mouth of babes. Kind of the concept really, and this is sort of, we're close to closing here, is really the captive mission is really one to reduce the overall long-term cost of risk. Captives need to be thought of in terms of a long-term venture. You don't need to get in it for a year and say, we'll try it out. You need to spend a lot of time on the front end understanding the concept. You shouldn't get in it if you're not committed to it for 3 years at a minimum. You need to know the members. If you're getting into a group captive, you should know who the other members are. You should ask sophisticated questions about how much risk sharing among the members have gone on, because I assure you one of the things that clients tend to think is that all captives are created equal, and they really are not. They are structure can be disadvantageous to the large account if you're not careful the structure that you get into. You can have what we call homogeneity risks. Kind of against our advice, one of our clients formed a captive, for instance, that was all a group related to home building contractors, which sounded really well when it was we had 2.5 million housing starts, but when we went to 600,000 housing starts, everybody's in trouble, and it's not in trouble because the captive's in trouble. The captive's in trouble because the underlying people's businesses are in trouble. So that's kind of a homogeneity risk that you can have. You can certainly have a mismatch of risks inside the captive. I've seen captives that have $175,000 widget manufacturer in beside somebody who's doing a $6 million pipeline construction, gas pipeline construction contractor. So
that was going to be my next question. Is the the difference? I'm thinking, would you take a contractor and put them with anybody? Because the risk is so different when you're operating outside of 4 walls as opposed to a manufacturer where you control things.
Yeah, I mean we don't. We have contractors in separate captives that are not homogeneous in terms of contractors, because there may be electrical contractor, maybe HVAC, maybe mechanical, they may be street and road and those kinds of things, but they're all contractors. Whereas you could have a distributor in by a manufacturer, and you want to have, really for us, we think the important thing is to make sure that the risks are matched in terms of how they are exposed. You don't want to have somebody who is what we would call a high frequency, low severity client, which has a lot of claims but not very catastrophic. But you put them in a captive with somebody who has kind of high severity, low frequency, because that's sometimes not a very good match. So the main thing I'd encourage you as you evaluate the captive concept is to ask very sophisticated questions about who you're getting in bed with, what their history is, how much risk sharing goes on, because that is something that's, frankly, many clients aren't sophisticated enough to do the analysis just because this isn't their business, and sometimes some of the brokers are not very experienced at it. And so the captive sponsor many times has the ability to play ball with the client's money sort of without them really figuring it out. And so we certainly encourage you to ask a lot of sophisticated questions. But the overall, the captives are a very good concept, provided you're in the right one, and they certainly can reduce the earnings volatility by using the captive balance sheet to absorb uneven loss results, as opposed to, say, a large deductible program that's going to give you a lot of volatility from a cost standpoint. A good captive will have, not only allow you to build equity inside the captive, but it will also have its own best practices standards, both from a claims and a risk control standpoint, that'll be absorbed. So,
got a couple of questions that have come in here. So while if you want to, we can flip to get the contact information up there. But a couple of questions here. Is there a trend by businesses to insure other business risks through the use of a captive as a means to transfer wealth?
No question. The 831B companies are used a lot of that for that, and what they'll take is other business risks that typically the client is absorbing, but they may not be financing in any way. In other words, they're hoping they don't happen, but they're not funding them in any way. So you'll take business continuation risk. They'll take terrorism risk. They'll take sort of price volatility change. All of those things, and insure them inside one of these 831B companies, and the owner, the insured under the captive, will be the company itself, but the owner of the captive may be a second-generation trust or an ESOP or some other ownership mechanism. So the profits that flow out of the captive will be some other entity. And that'll be true for whether it be group captives or 831B companies. Certainly the 831B companies are being used mostly to manage tax outcomes, but all captives are certainly being used to transfer wealth multi-generationally.
This is a follow-up question then, is what do you see the reaction of banks are when they start to see equity being transferred out of a company into a captive? Any particular reaction?
Not so much, because really what's happening is you're not really transferring the equity out of the company. What's happening is the new captive ownership company is being set up, and frankly the insured or the company that's the customer of the bank is still paying premium into the Hartford or the CNA. What's happening now, though, is that the risk that's being assumed is on the part of, say, the second-generation trust or the ESOP or whatever, and those are the profits that have been flowing to the insurance company are now just flowing to another related party in the transaction.
Okay. Well, I think that that wraps it up for questions. Jeff, do you have any last comments? Or
I don't.
Okay, great. Well, I want to thank you guys for taking your time to present to our friends and clients out there, because it's certainly an area in the risk management that they need to have an awareness of. So as that wraps it up, I do have the last CPE code, and that last CPE code is 48. And so again, if you are looking for continuing education, fill out the form. I would also ask you to fill out your evaluation form, because again, we tailor our presentations to meet your needs, and looking at topical items to present that that bring value to your desktop. So give us your feedback. Our next webinar will be March the 15th. The speaker will be Michael Kirsch, and he will be providing an economic update for 2012. So with that, I'd like to thank everybody for listening in, and have a good day.